Anyway, so this crash didn't happen. Let's move on. Let's say if a crash did happen, maybe there's some advice that you can take. Let's move on to this next story, okay? So if a crash did happen, which is possible. Again, major crashes have happened 3 in the last 20 years. They usually happen every 10 years or so. There was one in 2000, 2008, 2020. So who knows when the next one happened. There's 3 things that basically, according to the Motley Fool, that you should not do if there's a stock market crash. Are you ready to get into these 3 things? Here are the 3 things that you should not do if there's a stock market crash. Number 1, I wholeheartedly agree with, don't panic sell. Don't panic, don't panic, don't panic, don't panic. All right? Investing should not be emotional. Investing should be watching like grass grow. It should not be exciting. I always say that, you know, the Wolf of Wall Street, Jordan Belfort, made stock investing or stock trading exciting. And then he ended up in jail, and now he's worth minus $100 million.
Yikes.
Stock market investing should be frickin' boring. Compound interest, as exciting as it may be in your portfolio, ain't exactly exciting. It should be watching like paint dry. Over time, you build wealth. I like getting rich slow. I like building wealth over time. I don't freak out. Like every day, I'll look at my Apple app, and I see the market's red, the market's green, it's up. But over time, the market grows at about 10% year over year. Okay, I know that. Stock market. We're talking the stock market here, David. Yeah. All right, so number 1 is don't panic sell. If someone tells you the stock market is going down, if you see the market, just chill out, bro. Don't let your emotions get the best of you. So it actually, here's a funny little study right there. Fidelity, major bank, I actually bank with them, major wirehouse. You know who they said the most successful investors they have are? They basically said the most successful investors they had are either dead or forgot they had an account. LOL. Why?
So funny,
because they weren't panic selling.
Right.
I mean, they were dying.
Right.
Or they forgot they had an account and they just left their money in the market.
Yeah, point is just leave it.
Leave it in there. Let it marinate. Let compound interest do their thing. Don't try to trade. Don't try to time the market. Don't try to buy the dip. Don't try to get in and get out.
So you wouldn't suggest that if something's down, instead of panic selling, maybe, hey, take it as it's on sale. Tesla's on sale.
Yes.
Get some. So buy the dip.
Well, it's the trick with that is, when do you know the dip is? If the market's at 38 right now, 36, and it goes down to 30, oh, it's the dip. Then it goes down to 25. Oh, is that the dip? Then it goes to 22. All right, now it's coming back up. Like, it's impossible. So there's something called dollar cost averaging. That's what I've done since I'm 27 years old. Now I'm 40.
Okay.
Dollar cost averaging is basically saying, I don't know where the market is today. I don't know where the S&P is today, but every paycheck, this is a hot tip for everyone out there. Every paycheck, I'm throwing some money in the market. Boom, paycheck, 10% going in. Boom, 10%. So every year I max out my 401k. That's $19,000 a year. When I was making less than 120 grand at a certain point, I'd max out my Roth IRA. And if you make more than a certain amount, you can do maybe a backdoor Roth IRA. There's tax incentives, tax advantages. You can put in about 6 grand in your Roth IRA if you don't have an employee. If you don't have an employee match, that's free money, baby. Take that money. But the point is that you can't be panic selling. And especially if you're young, you've got time on your side. It's like, I'm going to say, like, people are going to say, Saz, you already said that. You know, you already said this. They can't. But that's my point, is it's the same concepts over and over and over again. I say this every week, David. 50% of money and your financials is knowledge. Okay, I get it. I understand I have a 401k. I understand saving. But the other 50% is behavioral. Are you actually freaking doing it? Are you actually getting out of debt? Are you actually putting 10% of your paycheck into your 401k? Are you actually doing it? That's the hard part.
Yeah, and that's what most people don't do, is put it into practice. Yeah. Oh, a Roth IRA. Oh, that's sick, man. Yeah, you can make a lot of money.
Yeah, I know about a Roth IRA.
Anyways.
Yeah, I heard that's great. Are you putting money in there? No.
Exactly.
What are you waiting for? So, again, the most successful investors are either dead or forgot they had an account. There's a lesson there, is that just keep your money in the market. Again, investing is long-term. Long-term, whether that's 5 years in a brokerage account or a Roth IRA, or whether that's freaking 40 years in your 401k. Let the pasta sauce marinate.
Yeah.
Let it marinate. You know, it's like, you know, you ever walk into an Italian grandma's kitchen, don't touch the pasta sauce. She wants to marinate it. That's what's going on. Let it simmer. Let it simmer.
Let it cook.
Okay. You know Warren Buffett's famous line when it comes to risk and investing, right?
What's that?
I think it was in 1986. He had a shareholder meeting. Famous line. And basically he says, we attempt to be fearful, when others are greedy, and we attempt to be greedy when others are fearful. Do you understand what I'm saying? Be greedy when people are fearful, and be fearful when people are greedy. So when people are getting too greedy,
Yeah.
and everyone's making money. Everyone's making money on Bitcoin. Everyone's making on NFTs. All this Dogecoin's going up. Be very fearful.
Yeah.
But when everyone's panicking, everyone's selling, everyone's, oh my God, the world's coming to an end. Now's the time to be greedy and invest. So don't follow the crowd is basically what this is. Don't panic sell. There's always going to be hype in the news. There's always going to be people telling you. The news, the financial news media, if they actually could tell you stories that are new, they'd run out of stories. Because it's the same shit. Hey, 5 ways to make more money. 6 ways to improve your wealth. 8 ways to invest. It's the same stuff. Understand getting out of debt. Understand interest rates working against you. Understand that you need to have an emergency fund. You need to have a cushion. You need to save that money. Understand investing long term. Keep it simple. Keep your costs low. It's the same stuff.
Right.
But they got to spin it in a million different directions so they can sell papers or sell viewership. It's the same stuff. Like, I wish I was reinventing the wheel over here, telling you to save that money. No. The Richest Man in Babylon, it was a book that I read 10,000 years ago when it was written, whatever it was. It's the same stuff that's applicable today. Have a budget. Have a game plan for your money. Understand what's going on with your money. Debt is your money going backwards, right?
Right.
Save that money. You're going to need it for sure. Invest, compound interest. Have insurance, protection, a moat around your castle back in the day. Now that's life insurance or disability insurance or health insurance. And last but not least is retirement, what I call chilling. It's the same stuff. It's just a different terminology. Anyway, that's what that's number one. Sorry, I'm ranting here, David. 3 things you should not do if there's stock market. Number 1, don't panic sell. What's your point? Anyway, because when you panic sell, that's like taking an L. Nobody wants to take an L. You only take an L when you sell. Take an L when you sell. That rhymes. Okay. Number 2.
There we go.
Number 2, don't ignore the business, the actual business. Like Tiesto.
Yeah.
Let's get down to business.
Hate that song.
You hate that song?
It's a
We've
cringy
had a
song.
million nights just like this.
I hate it
But
more
let's get down to biz. Anyway, don't get distracted by essentially where the price of the stock is or where the S&P is or the price of the index. The most important factor is that you're understanding that when you're investing in a stock, you're investing in an actual business with real profits or real losses and supposedly long-term agendas. So understand that when the market's up and the market's down, there's a story behind it, and that are actual businesses. Those are actual maybe 500 businesses in the S&P 500, and they're going to do all right over time. Understand that. So basically what I'm saying is stay rooted in reality.
Right.
Okay? The businesses are going to get down to business. Don't forget, you know, the rumors, the gossip, the Kiyosaki saying their crash. Don't ignore the business. These companies are still making profits, right? Microsoft, I think, just took over Apple as the most as the number 1 company in the world.
Oh,
Yeah.
okay. Sorry. Yeah.
In terms of market cap.
Yeah. All I heard at first was Microsoft took over Apple. I was like,
No.
pardon?
In terms of market cap. All right, number 3, what you should not do if there's a stock market crash. Don't stop investing.
Wait, you said number 3?
Number 3. There's
There's
3
2 ways.
reasons. Number 1, don't panic sell.
Huh.
Number 2, don't ignore the business model that are going on with these companies. Number 3, don't stop investing. Don't stop investing.
Cool. Yeah, I was on. Yeah.
Can you sing that song?
Just the Miami boy, born and raised.
Born and raised in South Beach. He's been to strip clubs and live all night long. Yeah, okay. Anyway.
Uber ride going
Go Uber ride going anywhere. Respect to David. I love when you sing.
Just the millennial. I can go on
You
forever.
want to keep going?
No, we got to get to
Okay.
these 3 things.
We got to get this in. And number 3 is don't stop it. But don't stop believing, don't stop investing. We talked about dollar cost averaging, right? Keep on, keeping on, keep on, keeping on. Every paycheck, boom, I'm putting $100 in. Every paycheck. Whether the S&P's at 2,000 or at 4,000, the Dow is at 20,000 or at 40,000, whatever it is, I'm putting money in. Whether Bitcoin's at 30,000 or at 60,000, if you believe in Bitcoin, every month, every paycheck, put another $100, put another $1,000. That's what's called dollar cost averaging.
In this economy?
Okay.
Just kidding. Yeah.
And that's a very simple way to basically avoid making emotional mistakes. Stop overthinking. I don't know. Is the market going up? Is it going down? Is it going left? Is it going right? You just keep on investing, whether that's in your 401k, your Roth IRA, your Bitcoin, your brokerage account, whatever. If you believe in the asset class, and you believe that the world is not ending, just keep on keeping on.
Keep on keeping on.
Don't stop. Anyway, so essentially it doesn't matter if the market's high, if the market's low. It doesn't matter what happens with that. Dollar cost averaging. Don't stop investing. Okay? So again, I've lived through 3 crashes. Okay? 2000, when I basically was in college, I couldn't spell investing at that point. Certainly couldn't spell 401k, that's for sure. 2008, when I started investing, basically I think I started investing. They're like, how much money did you lose? I'm like, nothing. I literally just started investing like last week. Nothing. Okay? And I've been maxing out all my stuff, 401ks, Roth IRAs, all my brokers, putting as much money into that since 2008. From 2008 to 2020, there was the longest bull market in American history. And I've seen the money grow and grow and grow and grow and grow. And I tuned out the noise. You know how long over the last, before COVID, I mean, there's a market crash, oh my God, what's happening next? I just tuned out the noise. Boglehead's Guide to Investing. I talk about that book, right? Jack Bogle, Vanguard. Tune out the noise. Keep your costs low. Stay the course. It's simple if you actually can tune out the noise. So there's going to be a lot of distractions. There's going to be
ignore all the Kiyosaki predictions, all that. Just keep on keeping on.
If you're young, for sure. Now,
So
if you're
if-
old,
You better listen to that.
You know I've done this thing before?
Yeah.
If you're young, have a lot in stocks, little in bonds, right? If you're 20,
Yeah.
30 something, stock up, bond low. Now, if you're old, if you're 70, if you're 80, and there's a crash coming, you better be in 75, 80% bonds. So even if there is a crash, you've got your bonds stabilizing your portfolio. It's actually not that complicated when you just understand this whole thing. This is what it is, David. Let me see one of these from you, baby. Yeah. If you're at home, you're watching this. Give one of these. Yeah. You want to give one of these too?
these.
What's up? What's up?
Hey, all right.
And now we're up here. Okay.
Hey.
The point is this. If you're
Poncho.
young, don't let the nonsense in the news distract you from your long-term goals. Save that money, invest that money, tune out the noise, stay the course. There's the advice right there.
Talk is money. All we talk is money.
If you enjoyed that short clip from the Soscast, click here to watch another, click here to watch the full episode, or just stay broke.